Hello friends, welcome to my channel TJ the Tax Accountant, a place where we discuss the basics of tax accounting. Before we start our today's topic, please remember to subscribe to my channel and hit the bell icon so that you are notified whenever I post a new content on the channel. And also your subscription lets me know that I'm doing the right thing by posting these videos, and it keeps me motivated to keep coming up with the new content. So our topic of the day is journey of a journal ledger account from a tax perspective. So we'll go over a regular journey of a GL account which is initiated in the finance department and then goes through the accounting, and what role does the tax department play in its journey. So if we look at the life cycle of a GL account, a new GL account can be conceived by any of the department. It could be HR, it could be sales and marketing, even tax, and any other department that has got anything to do with financial transaction. They may ask the accounting department to create a new GL account in order to enhance their reporting capabilities, or to identify the items of expense or income which affects their day-to-day work. The next step is approval and creation of a GL account in the ERP system. So once any department puts in a request for the new account, it runs through the internal control system of your organization and ultimately gets approved by the accounting team, and then it gets created in the ERP system which is used by our organization, which could be anything like SAP, Oracle, BAN, or any other kind of ERP system that your company is using. The next step is mapping of that GL account which is newly created into the financial reporting system. So the financial reporting system is the next level of the ERP system. So all the data of ERP system gets reported on the financial reporting system, which could be like Hyperion or Tagetic or any other kind of financial reporting system that your company is using. So that is used to condense the information which is recorded in the ERP system into more reportable and publishable format. So up until here, there is very minimal involvement of tax department. So where we pitch in is the next two steps. So once a new account is created and it's all set and ready to go, the tax department is responsible to do a tax sensitivity test on the account. So what we mean by tax sensitivity test is that to check whether the amounts that are being recorded in that account or the transaction that it is covering, does that create a book tax difference? And if it does, then what kind of difference it is and how to treat that in our tax provision, and then how it is to be treated on the tax return. And the last but not the least, the step from tax perspective is to mapping of that new GL account into your tax returns software and into your tax provision software or work papers, however you are doing your provision. So what that means is once you do the tax sensitivity test, and if you arrive at a decision which is that it is a tax sensitive test, then it's a tax sensitive account, then it would either be a temporary difference or a permanent difference, and then accordingly you will have to code that particular GL account in your work papers and in the software you're using, so that it gets reported at the right place and you are able to calculate your taxable income accordingly by taking into account the new GL which is being created. So now moving on to a deeper dive of the role that tax department plays in the life cycle of a GL account. So the key steps that a tax department performs is, first is the identification of the nature of the GL account, whether it's an income account, expense account, or a balance sheet account like a liability or an asset or any other equity related account for that matter, then you are required to perform a tax sensitivity test, which tells you whether there's a book tax difference in the account that is being created. And then, as we discussed, we map that GL account to the relevant book tax difference which are already existing in your work papers and on your tax return. And then the last step is to sync the mapping of that GL account in your provision work papers and tax return work papers. So for example, if you identify that the new GL account is an interest expense and you happen to have a temporary difference for interest expense, then you should code it to the same interest expense which already exists in your work papers for provision as well as for your work papers in tax return, so that you can accurately report it for your provision and tax return purposes, and also you can easily see any return to provision differences on account of that interest item. So now the final slide of today's presentation is why is it important to review a GL account, and why does tax need to complete the entire life cycle of a GL account. So the first reason would be that in your trial balance, as a prudent tax professional, you should be analyzing each and every single account which is on your trial balance to make sure you are able to calculate the accurate tax expense and tax liability for your provision and tax return. The tax sensitivity test, which determines any book tax difference and also the nature of the book tax difference, whether it is temporary or permanent, that needs to be done, and it can only be done when you are reviewing the trial balance in its entirety, including any new GL account that has been created. The third reason is, if you do not perform that tax sensitivity test, then you will be leaving out certain aspects of the taxable income calculation, and then whatever tax rate or tax expense that you're reporting on your provision or on your tax return may not be accurate, and which may in turn result in any qualified report by your statutory auditors on account of inaccurate tax expense calculation. And if your tax expense is not correct on your tax return on account of incorrect income being reported or expenses being deducted inappropriately, that may result into some hefty penalties and fines on which can be imposed by the tax authorities in your jurisdiction. And lastly, if you are doing this process correctly, if you're doing what is necessary in the life cycle of a GL account, it will be very, very useful in creating a tax automation process. So for the automation, in order to install any kind of automation or create any kind of automation in tax process, it is extremely important that all your data that you are processing through your work papers and workbooks is accurate and good. Only then tax automation can be of any use, because if your data is a garbage, then whatever you automate will give you and will be a garbage in the end. So it is extremely important to identify the new GL accounts and make sure you are doing all the steps that a tax department should be doing. So that concludes our today's presentation, and please do subscribe to my channel if you find the content that I post useful for you to learn more about the tax world. And I do plan to put some more content. I know I've been a little slow, so I'm still working on creating some MS Excel tips which are useful in tax arena. Some simple tools that everyone can use to review their tax provision, and any process improvement and automation which can be identified and easily corrected in order to achieve faster and more accurate processing of tax data. Thank you, and that concludes our today's presentation.